Okay, in this video, I am going to go over the balance sheet methods, accounts receivable, and I'm going to talk about the percent of accounts receivable and then aging of accounts receivable. Once we talk about percent of accounts receivable, the aging part's actually pretty straightforward. And again, these two approaches, the two balance sheet approaches, is a way for us to estimate the bad debt expense in a particular period, right? Percent of sales is one approach, and then these two are the next couple of approaches. All right, so I'm going to start with the percent of accounts receivable approach. And there is a really good slide, believe it or not, in this textbook. It's this right here, okay? So the formula is going to be bad debt expense, total estimated bad debt expense, minus the previous allowance in accounts receivable equals the current bad debt expense. Okay, this is almost okay. It's not perfect, but what we're saying here is I have accounts receivable, all right? I have accounts receivable, and I also have an allowance for doubtful accounts. Okay? When I'm using the bad debt approach, using the balance sheet, what we're saying is, hey, listen, if I have $100,000 in accounts receivable and I have $5,000 in my allowance for doubtful accounts, what we're saying is we anticipate collecting $95,000. Okay? Now, let's talk about what the bad debt expense is going to be. So, total estimated bad debt expense is going to be a percentage of accounts receivable, right? And so I could say, hey, you know what? My year-end accounts receivable is 100,000 in this particular example. I assume that I'm not going to collect about 7% of that, and therefore my total estimated bad debt expense should be 7,000. Okay? However, I currently have 5,000 in the allowance for doubtful accounts, and therefore I only need to add an additional 2,000 to this account in order for me to accurately reflect the financial statements. So if I were to add 2,000, then I'm saying I anticipate collecting 93,000. Okay? So the journal entry would be bad debt expense 2,000, and my allowance for doubtful accounts credit 2,000. We are saying the current year's bad debt expense is the total estimated uncollectible amount less the previous allowance for doubtful accounts. The book has an example, and in the book's example is basically saying, hey, listen, we have 50,000 in accounts receivable, all right? And we have $200 in the allowance for doubtful accounts. That's this 200. Okay? Then what we're saying in this particular slide, 5% of total receivables are uncollectible, right? So we have this total accounts receivable of 50, and we're saying of that, we're not going to collect 5%, right? So the total amount that we're not going to collect is 2,500, and they just basically gave that to us. So what we're saying is of the 50,000, we are not going to collect a total of 2,500. However, if I've already got 200 in the account, then I only have to add 2,300. Same concept. So in this particular example, bad debt expense is 2,300, and my allowance for doubtful accounts is 2,300. Okay, the third method of estimating bad debt expense, the aging of accounts receivable. All right. So let's find that slide. Aging of accounts receivable. Okay. Uh, Actually, you know what? I don't even really care for this slide. I'm going to go to my paintbrush. Let's assume I have accounts receivable. Let's assume that I've got a $200,000 balance in there. In the previous approach, where we just said, hey, we're going to estimate a percentage of total accounts receivable that we're not going to be able to collect, that's a fine approach. It's totally accepted. However, there's a more sophisticated way that we can think about the 200,000. And the way that we can think about the 200,000 is, hey, listen, if there is a subset of customers who haven't paid us and it's been like, 90 days since they've owed us money, the likelihood of those customers paying, it goes way down. And alternatively, somebody who just purchased a product or service and owes us for that, if it was very recent, all else equal, based on the credit approach that we take and the credit reports that we review, we're pretty good at managing our receivables. So generally it's the case that most people pay. Okay. Unfortunately, people fall into hard times or whatever reasons. So what we're going to do under the aged receivables approach, right? I'll just call it aged receivables approach, is I'm going to take this 200,000 and I'm going to break it up into buckets. And I'm going to say, hey, what portion of the 200,000 resides in 0 to 30 days outstanding, right? And I'm going to make stuff up. I'm just going to say, hey, you know what? We have $100,000 in that 30 days or less outstanding. Then I'm going to have another bucket that's 31 to 60 days. And in this bucket, I've got 40,000 of the 240,000 are 31 days to 61 days outstanding. Then I can do 61 to 90. And I can say, hey, you know what? I've got 30,000 in this bucket. And then finally, I've got anything greater than 90. And I've got 30,000 in this bucket, right? The total is 200,000. And what we're saying is now we can apply some estimates. We can say, hey, you know what? I think 2% of these won't be collected. So 2% of 100, 2,000. I think, the probability now goes up slightly, but I'm thinking 4% of these aren't going to get collected. 4% of 40,000, you guessed it, I can't do this in my head. Based on my calculator, I'm getting 1,600. And just out of curiosity, is it more embarrassing for me that I can't do math in my head, or is it more embarrassing for you that somebody who can't do math in their head is teaching you accounting? Anyway, okay. Let's say that, let's make it easy. Let's do one that I can do in my head. But again, the more days outstanding, I should say, a receivable is, the less likely it is we are going to collect, right? So likelihood. And 10% of 30,000 is 3,000. And then finally, boy, this last bucket, man, you know what? The probability of collecting this last bucket is really low. Okay? It's like 60% chance of not getting collected. And if there's a 60% chance of not getting collected on 30,000, I'm thinking, boy, I can do this in my head. I'm thinking we're not going to collect 18,000. Therefore, right? The total uncollectible amount, this is total receivable, and the total uncollectible is going to be 18,000 plus 3,000 plus 1,600 plus 2,000. What is that? 18,000, 21,000, 22,600, 24,600. Okay, we are thinking that of the 200,000, we're not going to collect 24,600, and therefore the net realizable amount is, forget it. I can't do it in my head. I'm getting 175,400. Okay. Now, what's the adjusting entry? The adjusting entry is going to start with, remember, it's going to be the same type of analysis that we did with the percentage of receivables. Okay. I am going to first look at the allowance for doubtful accounts, and I'm going to look to see what that balance is. And let's just assume that it's currently 16,000. So what we're saying is we need to go from 16,000 down to 24,600, and therefore, what should the adjustment be? And you guessed it, I can't do it in my math. But, sorry, I can't do it in my head. I can't even speak English. But anyway, 24,600 minus 16,000 is, can't do it. Okay, based on my calculator, the adjusting entry should be 8,600. Okay, so the journal entry would be, I'll just do it down here, bad debt expense, 8,600. And the allowance for doubtful accounts, 8,600. And again, we first estimated the total uncollectible amount based on aging the receivables. And then we compared what is currently in my allowance for doubtful accounts relative to what should be in my allowance. And the adjusting entry for bad debt expense is the difference between what it currently says and what it should say. And that, my friends, is the balance sheet approaches, the percentage of receivables and then the aged receivables.